The financial statements are for the year 2016. Okay, so we have a final structure for the year of 2016, and we have financial statement which will be available at best by June 2017, sometimes even later, sometimes even only by October or later. And we need a projection for our final structure for the end of 2017 in order to plan the 2018 budget. Okay? So we use our budget for this projection, and here I want to show you a two-stage process in which we create an initial projection in which we have only partial information, and then we refine it to a better projection once we have more data available. And then I will show you how this is translated to a financial strategy for our organization, okay, which will be the final goal of this entire thing. The entire purpose of looking at the financial statement, apart from, we may be interested and stuff like that, we have to sign on them, but for the purpose of this class, the entire purpose is to eventually have measures which will enable us to plan, to make a plan for financial stability, to create a strategy for financial stability. Okay, so this is the table in which we enter the projected data. Now here, I've given you this data in the exercise. I will also give you the data, and obviously in the assignment, I will give you the data. In your professional life, you have to come up with these figures, and I want to explain what exactly we take here, okay? Also, the numbers here are the actual numbers, since these are reports for 2017, so we already know what was the income, what was the expenses. So I can use something which is called by economists the perfect foresight method, which says, let's assume that we had a perfect foresight of the future, what we would have predicted, but it does not in the perfect foresight assumption does not inflict on the methodology. Obviously, if we don't have perfect foresight, we will use data. We will get results which are less accurate, but the process will be the same. All right, so now we start with income. As you can see, income here is divided to two lines: unrestricted donations and income, including income from all other sources, and restricted donations. And you can see the figures, 9,067,000 in the first line, in row 119, and 0 in 120. Now here, I want to explain. We saw already that in order to understand the breakdown of the surplus between operating reserve and restricted net assets, these two, okay, we have to be able to allocate both income to restricted and unrestricted, and expenses to restricted and unrestricted sources, okay? The overall surplus or deficit, which represent here, includes in it both surplus or deficit in restricted and unrestricted. Now, when we look at the data that are available to us during the year, so income, we always know when we receive income if it's restricted or unrestricted. Okay, it is determined in the terms of the grant, and I'll give you a few words on explanation about that. But for expenses, that information of how expenses are allocated between restricted and unrestricted, this information usually is not available during the year, and it only becomes clear at the end of the year. Now, let me explain that a little bit. So, if you remember in the previous part at the beginning of the semester, when we looked at the initial economic map, we allocated both income and expenses to programs, and the allocation of income was according to well, that's what I refer to then as restricted and unrestricted. But the allocation here in the financial statement of income between restricted and unrestricted is slightly different. There is a subtlety here that we need to understand. Because in the economic map, the considerations were operational. We decided if income was part of a program or not part of the program will be shown as an income of the program or not income of the program based on the criteria which was operational. We ask ourselves, if these programs did not exist, will that income still be there? Okay, so if we have, for example, a government that has an agreement with the organization in which it buys services and pays based on service recipients, as we saw in the exercise, then obviously this income depends on the existence of the program and therefore was allocated to the program. But the terminology in the financial statement is slightly different because in the financial statement, the restricted net assets relate only to donations or maybe government grants in which we have to report the expenses, report on the expenses in order to receive the income. So it's a more narrow definition. It's a narrower definition because only these donations or grants for which we have to report the full expenses in order to get the income are under restricted donations or restricted net assets. So for example, the previous example of government paying for services, although it will be included in the income for a program in the economic map, it is not a restricted donation in this definition, because if there is a surplus, if the government paid us and we had a surplus, the government will not ask the money back. They don't ask for receipts or expense report. They just have a certain rate that they pay per service recipient. So what we have here as restricted donations are only these donations that have a clause in the grant that you have to report the full expense in order to get the money. Okay, so this is important for your professional life. For the exercise and the assignment, I will give you the figures. Okay, so it's not something that you have to be worried about, but it's important to understand this distinction. So that is why when I say that from the beginning we know what is restricted and what is unrestricted, basically it means that this line 120, will include only grants in which there is a reporting clause and we have to report in order to get the money, and the rest, which is unrestricted donation and in other income from all other sources, will be here under the unrestricted, which means that any surplus can be used by us freely without any restrictions from somebody else. Okay? So is this point clear? It is, I would say, a challenge to do that in the professional life, to distinguish between what is restricted and not unrestricted. I mean, it's not, difficult, but it's something that needs to be done. Here in this case, all the income of the organization was unrestricted. There were no restricted donations that were received in 2017, and this is information which we know from our budget. In our budget, when we enter any income to program, we know in advance whether it is part of restricted or unrestricted based on this definition. Okay? Now, the next stage, we have our operating expenses. Now here, the operating expenses includes everything. It includes expenses for program, it includes general and management, overhead, everything. Because for the purpose of financial stability, it's not important if it was spent on program or overhead. It's only important that it was actually spent. So here we have basically our total operating budget. And here we have the budget or the part of our budget which is devoted to fixed assets. So if we plan to buy fixed assets, we will enter that in the budget. We will have a projection, and that projection will appear here. Now, why can't we allocate the operating expenses from the beginning to restricted and unrestricted? So that is quite a challenge. What happens at the end of the year is that the organization, when it starts to prepare its financial statement, the organization is asked by the accountant to separate the expenses which relate to restricted net assets or restricted income. And then the organization has to go over all its expenses, compare it to the grant letter, and see how much it can allocate to the restricted net assets. And obviously, the organization has an interest to allocate as much as possible to the restricted net asset so that it will have less expenses allocated to unrestricted and then more reserve, more operating reserve from the unrestricted sources. So this process can only start towards the end of the year when we have the full information about our expenses. At the middle of the year, it's rather difficult. Sometimes it's possible, but here I want to describe the case that we don't have the allocation of operating expenses between restricted and unrestricted, and therefore we have only the total amount. And so that will be stage one. And in stage two, we can see how we refine our projection by adding the allocation of expenses between restricted and unrestricted. Okay. Now, so basically, if you recall this connection, okay, so we have here, we can see here that the change in net assets, which is the sum of change in operating reserve and change in restricted net assets, equals to the surplus or deficit plus or minus the investment in fixed assets. This is the basic connection. So we use this connection here, okay? And we sum, see, this is the sum of income and expenses, and that is the expected change in net assets. So we can determine using this data that it is expected that we will have an increase in net assets by $1.5 million, but we don't know yet how this increase is allocated between the two components. Okay, so let me go back. So we can forecast this figure by forecasting the projected surplus and the projected investment in fixed assets. So we can focus this figure, but we don't know yet how it is allocated between the two components, operating reserve and restricted net assets. Okay. Another point which is important here is the signs. Okay, so it is very important that income will be recorded with a plus sign and operating expenses with a minus sign. Investment in fixed assets can be either negative or positive. It depends. We saw that we can have investment or divestment. Okay, so if it is positive, then it should be with a positive sign, which means if we sold more assets than we purchased, that will be in a positive sign. While if there is only a purchase of fixed assets or we purchased more than we sold, that will have a negative sign. Okay, so this is very important, the signs here. Otherwise, the entire projection will be wrong. So these parts give us the change in net assets. And we have to project also the change in debt. Now, the change in debt has two sources. One is the payment schedule of the existing debt, and the second is whether we plan to increase our loans, to take more loans. Now, again, the signs here are crucial. If on the net we increase our loans, then the signs will be positive. Okay, more we take additional loan, the immediate situation will be more cash, more financial assets. If, on the other hand, we repay the loan, the net is just repayment, the sign will be negative. So here the sign is positive. Again, I will tell you both in the exercise and in the assignment whether it's an increase or decrease, whether it's more loans or payment on loans or increasing the loans, and based on that you will have to put the sign. Here the sign is positive, so the change in financial assets, again, if we go back to the equation that we have here, so we saw that the change in financial assets, okay, analysis of change in financial asset equals the surplus or deficit plus investment, which is change in net assets, plus the change in long-term debt, okay, plus or minus, depending on whether we increase or decrease the amount of loans. Here it's a positive, so the expected change in financial assets here is 1.541. All right, now, your job here in this part is only to enter the data and to do it correctly. All the rest is now calculated, and I want to show you what we do with these calculations. So the first thing is that we have now here a projected simplified balance sheet for the end of 2017. This is what we're looking for, because this will be the base for our financial strategy. Okay? Now, this column D, is basically the same simplified balance sheet that we had already for 2016. Okay, so let's see it. It's identical to this column E here in the simplified financial balance sheet. This is the end of the previous period, which becomes the beginning of the next period. Okay, so this is taken from the simplified balance sheet. Then we can use the projections here in order to project the financial assets, okay, at the end of 2017, and other components. So let's start with the financial assets. So if the projection is that financial assets will increase by 1.54, it means that the new financial assets will be, you can see the formula, the previous plus the change. Okay, so here's the change is positive. You can see here the change. You can see that that's exactly the same number. Again, this is not the calculation you have to do. It will be done automatically. So we can see an increase of financial assets from 13.3 to 14.9. Okay, this is the first stage that we can deduct from this projection. Now, if we go to the sources of funding, we can also project the amount of long-term debt, because we entered here the net change of 21,000. So the long-term debt will increase by that figure, 21,679, and here we can see the change. Okay? Now, if we go to the other two sources, restricted net assets, commitment to donors, and operating reserve, the internal saving, we can tell what will be the change in the sum of these two. Okay, we can tell that the sum of these two components, restricted net assets and operating reserve, which was 12.7, will increase by 1.52. Okay, this figure equals this figure, and it will reach 14.9. Okay, the same as, sorry, 14.2, sorry, 14.2. So that we can tell from the projection. What we cannot tell is what is the breakdown between restricted net assets and operating reserve. This is something that in this initial stage we cannot tell. Okay? So until now, is this clear? Okay, I have to assume that if you're quiet, it means that it is crystal clear and okay, all right. Now, although, look, we said that we have two financial measures, one for the short-term financial assets. We already have it, 14.9. So we have a measure for the short term, and we already can tell that according to our projection, the short-term position will be solid and even will improve, okay? Because the financial assets will increase. What we don't know is what will happen to our long-term measure, which is the operating reserve, because we only have the total change of operating reserve and restricted net assets, and we see here that operating reserve was negative. So it is very important to see whether operating reserve increased or decreased. So in this first stage that we are unable to tell that, we use simulations. These simulations appear here in starting from column I all the way to column O, and they present two cases, the worst case scenario and the best case scenario. Okay? Now, it is very useful to have simulation for worst case scenario and best case scenario because the actual situation, which we don't know, has to fall somewhere between them. Okay? So if we can tell what are the worst and best case scenario and the actual final situation will be between them, sometimes it is enough for us to determine our desired financial strategy. Okay, so let's see the numbers and then I'll explain. So what is the best case scenario? The best case scenario, which is described here in words, the expenses are from restricted income and the restricted net assets until the full use of the restricted net assets. Okay, which means that we want always to use as much as possible from the restricted sources, but there is a limit. We cannot use more than the restricted net assets cannot be negative. Okay, remember the restricted net assets are our commitments to donors. There is no situation in which the donors have a debt to us, okay? It is always money that we receive, what we haven't spent. So we want to spend as much as possible on the account of the restricted net assets, but there is a limit, which is the total amount of the restricted net asset. So this is being calculated here. There are many, as you can see, all kind of ifs, all kind of conditions that take care of that, so you don't have to worry about that. What we see here is that we had an initial amount of restricted net assets, 13.6. There was no income, additional restricted income. Now, the entire amount of, since the restricted net assets are much higher than our expenses, even including the investment in fixed assets, then the entire amount of operating expenses and investment in fixed assets is allocated to the restricted net assets. Now, it is important to understand this is not, people sometimes ask, why is that? This is not something that actually happened or will happen. It is just a synthetic description of the best case scenario from the point of view of the organization. And in this case, if this scenario will materialize, then all the income which is unrestricted will go to the operating reserve, and we will have the balance of the operating reserve will increase by the amount of the income. Okay, so it will increase from minus 907 to 8.16. Okay, so that will be the effect on the operating reserve. And on the other hand, in the restricted net assets, we'll have a reduction in the balance from 13.6 to 6.1, which reflects that all the expenses, both operating and investment in fixed assets, went or were allocated to restricted sources. Okay, so before I go on to the second scenario, is this scenario clear? Okay, so I got the clear sign. All right, now let's look at the other scenario, which is the worst case scenario. The worst case scenario from the point of view of the organization is that it is unable to allocate any of its expenses to the restricted net assets. So everything, all the expenses should be allocated to the unrestricted, or should go basically whatever balance there is should go, whatever surplus or deficit should go to the operating reserve. And we can see that here in the restricted net assets, there is no change, no income, no expenses. While in the unrestricted net assets, we have income of 9 million and something, expenses, investment, and eventually we have a balance, a positive balance. Why? Because still there is an increase in the operating reserve, in this case of $1.5 million, and that increase, or it closed the deficit in the operating reserve and brought it to 613,000. Okay, so is this clear? If you recall, there was a measure of the required operating reserve, right? We used it when we analyzed our operating reserve. The final structure, we looked at the gap between the recommended level and the actual operating reserve, and the gap was calculated based on 25%. Here we just show the actual percentage. So this comes from here. So this is the ratio of the operating reserve in this situation to total income. So operating reserve of 8.16 million divided by $9 million income is 90%. And here we have a smaller but still positive ratio of 612,000, almost 613,000 divided by 9 million. So in both cases, we have a positive ratio, but in the best case scenario, we are way above the desired level. We have more than adequate levels of operating reserve, while in the second, we have a level which is lower than the desirable level of 25%. Okay, now the first thing that we want to do, and again, that will be your part, is to give the verbal interpretation. So as you can see, this table, which is yours now, is divided to a certain part. The first part relates to the short term, and then we have long term, long run, two scenarios, and eventually conclusions. So let's talk first about what we see in each scenario, and then how we reach conclusion and what we do with these conclusions. Okay, so in the short run, the scenarios are not relevant because the short run is determined by the financial assets, and based on this projection, we already can tell that the financial assets, not only that they will be positive and large, they will be even larger than the previous year. So this is what is written here. The financial position in the short run is very positive. Financial assets are expanded, but here I have a mistake, are expected to increase to 14.8. So sorry for that, but I'm going to fix it right away, 14.9. I probably changed the number and didn't change the word. Okay, so we are going to have more financial assets, large number compared to our income. So in the short run, we can tell by these projections, without knowing how the expenses we are allocated, we can still tell that we don't expect any issue in the short run. Okay, which is very important because I will talk about strategy as soon as we finish that. Now let's look about the long run. So what happens in the long run? Scenario number one. So here it just states what I've just explained. The operating expenses of $6.8 million are allocated fully to restricted. The investment in fixed assets of 781K is allocated fully to restricted. Okay, so this is this part. Restricted net assets will decrease to 6.1. Okay, so the balance of restricted net assets will decrease. The nonprofit will have a surplus of 9.1, okay, which is its entire income. That will be added to the operating reserve, and it will have an accumulated surplus in the operating reserve of 8.2 million. Okay, so this is just a verbal description of what I've just explained. And once you write it, we make sure, you and I, that you understood what you saw in the table of the best case scenario. Okay, is this clear? All right, now, scenario number two, worst case, operating expenses of 6.8 are allocated to unrestricted. Okay, that's the scenario. Investment is allocated fully to unrestricted. Okay, so that's here. RNA will restricted net asset will remain at the same level of 13.6. The nonprofit will have a surplus of 1.5 that will be added to the operating reserve, and the operating reserve, the accumulated surplus of the operating reserve will be 613K. Okay? All right, so this is just a description. And before we move on to financial strategy, to the conclusion, I want to stop and ask you, is this clear? Okay, hopefully. Now, basically, when we talk about financial strategy, so I want to go back here. And if you recall, we looked at the previous class on this table of financial stability rank. And we look basically at three positions, which are divided to sub-positions. Okay, the first position is that both financial assets and operating reserve have a deficit. Then we have the intermediate situation in which financial assets are positive, operating reserve is negative. And we have the two stable position of positive financial assets and positive operating reserve. Now, what basically, when we talk about financial strategy, what do we mean? So our social strategy is always to expand, or at least to keep the level of activities that we have. Social organizations, they want to expand to provide more services, more activities. At least they want to keep the level of the previous year. They want to decrease. This is different from businesses, because a business, when it has a losing service, it will close it. There's no point in having a losing service. Okay, the business looks at the bottom line, not at the volume of its sales. But in a social organization, we want to expand. Now, financial strategy is aimed to financial stability. Okay, in order to have financial stability, we need to have an adequate level of both financial assets and operating reserve, which is the most important measure. And we also know what it's a measurable target, because we know what we want to achieve. We want to be in the area of 25% to 50%, or at least above 25%, in order to determine our stability. So here we have very clear target, and we have to determine what we do. And here once we have the measures of the expected measure, we can look at this table and we can basically define the timeline. When we talk about financial strategy, we need to define the timeline of whether we have to take actions or not. So what I want to suggest, again, risk assessment is subjective. I mean, people can be more risk averse or risk adverse. Some people will take more risk, some people will take less. But in general, what I want to say is that when we are in this situation, minus and minus, deficit and deficit in both measure, this is a very risky situation that can bring the organization down. And that requires action, immediate action. We'll see in a minute what it means. This situation where we are in 3 and 4 means that in the short term we are okay, but we have a problem in the long term. So it does not necessarily require an immediate action, but it does require an action. We do have to take care of the deficit in the operating reserve, because in the long term, if we don't take care of that, it will come back to us as a negative or deficit in financial assets. So it requires an action, but not immediately. And this situation is generally okay. We are in a solid position, but we want to bring it to the range of above 25% of income so that we can basically declare the achievement of our financial strategy. And then obviously to sustain that level of 25% and above. Now, if we go now to page 12, what are the steps that we can take if we need to take steps, like if we're in position 1 and 2 or 3 and 4. So I kind of order these steps in kind of a severity, starting from the less severe and going down to the more severe. And this basically takes us back to the first part of the semester. Here we close the circle, okay? We close the circle of what we have seen. So we saw already, if you remember in the table for fundraising, that undesignated sources can be used for increasing operating reserve. Okay, remember that, the table that we discussed in the previous part of the course. So first thing is focus the fundraising effort on undesignated sources, if it's possible. Okay, so this is a step which does not hurt. Okay, it's always good to do. Number 2, expansion of program or programs with positive economic contribution. Okay, so if you remember from our analysis of the economic map, if we expand program with positive economic contribution, we basically either decrease the deficit or increase the surplus, and by that we contribute to our operating reserve. Additional fundraising to existing program with a deficit in the full cost. So again, if we go back to our presentation to donors, remember that I said that every program which shows a deficit, not necessarily a negative economic contribution, it can have a positive economic contribution, but still a deficit. If we can fundraise to this program from restricted sources, we basically can allocate more unrestricted sources to our operating reserve. So steps 1 to 3 are not, they don't involve pain, okay? They don't hurt. They just basically more focus on our fundraising effort. 4 to 6 involve more pain. So 4 is rejecting new programs with negative economic contribution. Okay, so that is, again, we did that in the exercise. We looked at programs, and if the program has a negative economic contribution, and in case we have a negative operating reserve or negative financial assets, we cannot take programs with a negative economic contribution. We can only do that if we have positive operating reserve that will be able to subsidize that, okay? Now, number 5, decrease expenses of program with negative economic contribution. Again, this is a step to, since the negative economic contribution is the subsidized part of our programs, we can try to decrease the expenses in order to kind of have less negative economic contribution. And step number 6, in extreme cases, closing program with negative economic contribution. That is something that we saw in one of the examples of a recovery plan. So these are the steps that are required when we have negative operating reserves. The urgency of the steps depends on where we are here in this scale. So in this side of the scales, negative financial assets and negative operating reserves, these steps are more urgent, and we may have to revert to steps like number 5 or 6, even 4. Here, the steps are less urgent, but we still have to take them into consideration. So if we don't do them this year, we will have to do them next year. And here, we don't have to do the painful steps, but we can focus on number 1 to 3, on how we prioritize our fundraising so that we can reach the level of 25% and above. Okay, so this is basically what I mean by financial strategy. Now, if we go back to our organization and we look at this analysis here in the conclusion, so we can see that in both scenarios, the short-term financial position is very positive, which means that we are in not in 3 to 4, we are in 5 to 6. Why is that? Because in both scenarios also predict a surplus that will bring the operating reserves to a positive level. Okay? Actually, we are in 6. Okay, why in 6? And tell me why in 6. Look, let's look at 6. Positive, positive, and positive change. Okay, so in both scenarios, we have obviously positive financial assets, positive operating reserve, different level, but positive, and also positive change. Okay, so both scenarios are in 6. So basically, we know already, without even knowing, in this case, it's not necessarily in every case, but in this case, without even knowing what is the breakdown of the expenses, we can still tell from the two scenarios, best case or worst case, that we will be in the range of 6, which is obviously the most positive, and there are no urgent steps that we need to take. We don't have to reduce programs. We don't have to close programs. Still, in the worst case scenario, we are below the required 25%. So we have to think about a long-term plan for increasing the operating reserve. Okay, that is advisable to kind of come up with a program which basically will look at our fundraising effort and maybe even on looking at program and see if we can decrease negative economic contributions so that we will be able to increase the operating reserve. But as you can see here in this case, since both measures for the long term, they point to the same direction, we can draw a conclusion on what needs to be done already in this initial stage. And that is the power, the strength of scenario analysis, that in some cases, not in all the, sometimes the measures will point to different directions, and then we will have to wait for additional information. But in this case, in which both of them point to the same direction, in terms of what needs to be done, we know already what needs to be done. Okay? All right, now just for the final stage. In the final stage, which is towards the end of the year, sometimes even after the end of the year, the beginning of 2018, we have the breakdown of the expenses between operating reserve and restricted net assets. Again, here and in the exercise and in the assignment, I will give you this breakdown. That's not something you have to come up with yourself, but in professional life, this is something that will have to do with your fundraising department and accounting department. And here we can see that expenses are basically broken down almost 50-50 to restricted net assets and operating reserve. And we reach a situation in which we are basically in the middle of the range, which means that restricted net assets will decrease from 13.6 to 10.3, and there will be a positive surplus of 4.8, which will bring the operating reserve to 3.9, which is 43% of income. Okay? So here is the final conclusion. Here, what we're asked to do is just to enter again the data of the expenses, which you didn't have to enter here, and then reach the final conclusion. Okay, and the final conclusion, the operating expenses are divided 3.3 and 3.4. Investment is fully allocated to unrestricted sources. So therefore, there is a surplus of 4.85 that is added to the operating reserve. So the non-profit will have an accumulated surplus of 3.9, which is above the benchmark of 25%, and RNA will be decreased to 10.3. So there is no action needed. Financial strategy goals were fully achieved, and we just need to keep it in that range. All right. So this is basically the move from analyzing the past financial statement to creating a projection for the future in order to determine what needs to be done in order to keep our financial stability.